In this chapter, we're going to look at the balance sheet, which is part of the accounts, and we'll introduce double entry bookkeeping as well. So before we get stuck in, what are the accounts anyway? Well, the accounts themselves comprise of two key pieces of information. Firstly, the profit and loss account, which shows all of the income and expenses relating to the business for an accounting period, normally a year, which then results in either a profit if income exceeds expenses, or a loss if expenses exceed income. The second key piece of information forming the accounts is the balance sheet, and that's what we're going to focus on in this chapter. The balance sheet shows all of the business's assets and liabilities at the accounting date, normally the year-end date. The net effect of the assets and liabilities is known as equity, in other words, the amount or the value that is owed back to the owners of the business. Don't worry too much about the terms, we're going to look at all of these in a moment. Preparing the accounts themselves then is essentially a three-step process. First of all, you have to classify the transactions into the appropriate category. Are the transactions affecting business assets, business liabilities, income, or expenses? You then add up the totals for each of these categories and record them in the accounting records themselves. And finally, that enables you to produce the financial accounts on the basis of the information in those accounting records. So the accounting records themselves is where all of the transactions are recorded. These days, most accounting records are computerized accounting systems. They can be very, very simple off-the-shelf packages, or they can be very, very complex bespoke packages for large organizations. A very small, simple business might still maintain a manual accounting system, and of course, before the days of computers, all accounting systems were manual. As we go through this module, a lot of what we explain through how to account is based on the old-fashioned manual system, because every computerized system that we see nowadays is still based on the same principles that were established in those manual systems. So all of the principles of double entry and recording transactions are the same whether you use a manual or a computerized system. Having recorded transactions in the accounting records, those accounting records are then used as the basis for preparing the financial accounts themselves. Not necessarily just financial accounts, but other management information can be provided to the owners or directors of the business so that they can make effective management and business decisions. Most accounting systems also help businesses comply with legislation, for example, preparing tax returns and so on and so forth. So, let's have a look at this balance sheet then. What do we mean by the balance sheet? Well, it summarizes everything that the business owes at a particular date in time. Normally, accounts are prepared annually, and so all businesses have a year-end date to which they make up their accounts to. So, the balance sheet comprises of three elements. Firstly, the business assets. Business assets are things of value, things that the business owns. So typically property, fittings, stock, which is all of the goods that a business might sell in the future. Cash in the bank is an asset. The second category of items in the balance sheet are liabilities. These are obligations, amounts that are owed by the business. So bank loans, amounts owing to suppliers that have been purchased on credit. And the final category is capital. We mentioned this in the previous chapter. Capital is the amount of money that is used to set up the business. In other words, what the owner has put into the business. If it's a company, then it's share capital. So let's just have a look at the balance sheet just to help explain some of those terms in a bit more detail. This is exactly what a balance sheet would look like for a typical business. And you'll see it's split into two halves. Okay, the top half, which shows all of the business assets and liabilities. And those two items are netted off to arrive at what we call the net assets figure. The bottom half then contains information about the capital, what's owed to the owner of the business. So our assets then, I gave you some examples just now. So typically fittings such as furniture or computer equipment. These are sometimes all called fixed assets, and we've got a chapter dedicated to fixed assets in Unit 2 of the module. Stock. So stock are goods that are held for resale. So if we think about a retail business, a clothing shop, for example, the shop has to buy in clothes to put in its shop, and that's what's called stock. The unsold clothes will be the business's stock. Debtors, we came across that term earlier. Remember, debtors are amounts owed to the business by customers. Okay, so we might sell some of our stock, but say to our customers that they can pay for it later. So it's an asset, it's a thing of value. What the amount owed by the customer is our asset. And finally, cash or amounts in the bank account are also an asset because obviously it's a thing of value. So then our liabilities, the obligations of the business, the amounts owed by the business, will be amounts owed to creditors. These are amounts owed to suppliers. And amounts owed in loans or borrowings if the business has borrowed money. So like I say, those amounts are all added up to arrive at a total figure for net assets, the net of the assets less the liabilities. And then in the bottom half of our balance sheet, we have capital. So in this case, we can see that the owner put in 100,000 of capital, but has taken out drawings of 37,000. So drawings are effectively like a reduction of capital. So that's all our balance sheet looks like. So like I said, producing the balance sheet is simply a case of identifying all of the different business transactions that have occurred during the year and categorizing them into one of those three categories there. Now, it's no accident that the total of our assets less liabilities, net assets, adds up to the same figure as our total capital. This is what's known as the accounting equation. So we can always express our accounts in terms of an equation insofar as capital equals assets less liabilities, or capital equals net assets. So because of this, whenever we produce a balance sheet, it should always balance. And it's true of any situation. If you think about your own circumstances personally, perhaps you might be lucky enough to own the house that you live in, but you might have a mortgage on it. Well, suppose the house is worth 200,000. That would be your asset. But you might have a mortgage on it. Suppose that the amount of the mortgage is 140,000. That's the liability, the amount that you owe to your mortgage lender on your house. So the difference between the asset, the house value of 200,000, and the mortgage liability, which is 60,000 in this example, is effectively your equity in the house. Okay, so that's what your worth, if you like. And you might have heard across the term negative equity in housing. This happens when you borrow money to buy a house and then house prices fall to a level below the amount of mortgage that you have. That's what's known as negative equity.